And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the show. Of course, it is Tuesday as we get kind of the day underway already. It's early. Didn't sleep well last night. Lots of tossing and turning. Stuff going on in my brain. Couldn't get it to shut down.
You didn't have an FBI raid, did you?
Nope. Didn't do that. But very sad news today.
Yes.
Olivia Newton-John passed away.
I know.
Right? So Grease was the word.
Part of the soundtrack of my growing up.
I know. Right? So very sad. Singer, entertainer.
Mm-hmm.
Of course, most famous role was Grease with John Travolta. So yeah, she will be missed. Of course, you know, younger generation is like, who? It just goes to show you how old we're getting, Brent. You know, all of our childhood.
Yeah. It's saddening. It really is.
I know. Starting to see the beginning of the end, as they say. You know, it's interesting too. You know, we watch movies, and you know, I don't feel that old, right? I really don't.
Yeah, I'm still 17 inside.
Exactly. My wife says I'm 5 constantly, but I don't feel that old, right?
Yeah.
And then you know, you start watching some movie on television, and like my wife's like, "Well, when was that movie shot?" It's like, you know, you push the information button. It's like 1989.
We watched a movie over the weekend with Robert Duvall and
Yeah.
Robert De Niro in it.
Yeah.
They looked like kids.
Yeah, I know. It's crazy. And then, of course, you know, you just look at some of the actors like Tom Cruise and others. You
Yeah.
know, they're 50s, 60s now, and, you know, starting to push in the upper wrangling. So, yeah.
It happens.
Yeah, no, it's just those are reminders that we're all getting a lot older very quickly.
Well, more experienced anyway.
No, just older. So anyway, a couple of things. Let's jump over to our chart this morning, kind of get an update on yesterday's market action. You know, first of all, you know, as we've been talking about here for the last few days, market has gotten a little bit overbought short term. There are some very bullish kind of tendencies that are going on right now. So it's one thing, you know, worth paying attention to is that the 20-day moving average has crossed above the 50-day. Now, that doesn't mean a whole lot of anything other than a very short term. The market is trading bullishly. So that's what that means. However, the last couple of days, you know, this market's really kind of been consolidating in a bit of a range here. And markets look to open a little bit lower this morning. We'll see how things open up as we kind of get going. But, you know, we've had this very nice kind of 3-week rally from the lows. And, you know, the question now, the big debate is whether or not this is the beginning of a new bull market or if this is a bear market rally, and this is, you know, the back and forth. And, you know, right now the market has retraced about 33% of its drawdown from the recent peak. And, you know, and that all suggests, right, that, you know, the market is improving and becoming much, you know, a little bit more stable, shall we say. And so there's certainly an argument to be made, and again, a lot of people really hoping that, you know, we've seen the lows of the market correction, and, you know, this is, you know, and this is where, you know, we start to, you know, get the market to advance again. And of course, young retail traders that have never seen a bear market before in reality, and they haven't seen one yet, by the way. We have not been in a bear market, and I'll explain to you why in just a second. But you know, there is a lot of, you know, speculation in the markets. Just over the last week or so, we've seen the retail traders and the Reddit traders right back to where they were doing it back in 2020. It's like, this is the 2020 low again. That means we have to buy AMC and GameStop and, you know, Bed Bath & Beyond and these companies that are basically on the verge of bankruptcy. We're going to buy those and run those up a lot and make some money. And that's fine, right? There's speculative trading, nothing wrong with it. But, you know, if this was a bear market, you would not see that type of behavior because by the time you get to the end of the bear market, nobody wants to buy stocks. But importantly, and as we've talked about before, you know, this is not a bear market. This is a correction. And, you know, the reason that you know that this is a correction in particular is that if we go back to these lows, and again, let me get a little different chart here for you to make it a little easier to see. If we go back to these lows of 2009 as an example and take a look at this market and just draw a basic trend line, along these bottoms, right? We are nowhere near a retest or a change of trend in the markets, right? So yes, we've had a correction here, and we are correcting within a bullish trend long term. This is still a bull market for all intents and purposes, going back, to 2009. We haven't changed any of that analogy, and more importantly, if this market turns around and does what we saw back in 2020, which was also a correction within a bull market trend, a correction will immediately recover to new highs. In fact, if you go back and look at every one of these correctional points ever since 2009, you saw these corrections that immediately led to new highs, right? And that's not what you see following a bear market like we had in 2007. It took years to regain a new high. That's the difference in a bear market. And if you look at this previous bullish trend that we had going on in stocks in 2002, 3, 4, 5, and 6, that trend was clearly broken by the bear market in 2008. Again, ever since then, we have not come even close. And what's interesting is this massive spike in stocks caused by that $5 trillion worth of liquidity injected into the markets. We've created this massive deviation from the long-term growth trend of the market that still hasn't rectified itself either. So again, we're still within a correction within a bull market. And what a correction suggests is that if this was indeed the bottom, then yes, we'll almost immediately correct and go back to new highs and just keep going off to the moon, and everything will be great. The problem becomes, of course, the Fed's inflation fight. And I'm writing an article right now talking about this isn't Paul Volcker's 1982. A lot of people are hoping that, well, as soon as the Fed pivots, the markets will immediately recover their losses and we'll be off to the races. And the question is there's no pressure on the Fed to pivot right now. And as the Fed continues to hike rates, and as the Fed continues to push on this idea of slowing economic growth to quell inflationary pressures, if those pressures do not subside quickly, the Fed's going to keep hiking rates, and they'll eventually break something in the economy itself. We'll see a big unemployment spike, et cetera. And then that will have to get factored into stocks. So there's while in the short term there's technically a case to be made that this bear market is over, right? And again, technical indicators can suggest that 20's crossed above the 50, prices are rising. We've gotten above the 50-day moving average. We've had a 33% retracement. 50 days, stocks above their 50-day moving average are improving. Breadth is lots of bullish reasons to be long this market right now, right? We can make that bullish case. Then there's the Fed. And what we've been taught over the last decade is to not fight the Fed, but yet this is the very thing that investors are doing now, hoping that the Fed will bend to their will. And I just don't think that's going to be the case. Anyway, be right back after the break. Lots of stories to get into this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number. It's 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
CO2. You know, that's
CO2?
CO2. That's the big greenhouse gas that, we're all trying to fight, right?
AKA carbon dioxide.
Carbon dioxide.
Yes.
And it's interesting that, we have a shortage of CO2.
Really?
Yes.
So many punchlines, so little time.
Yeah. Well, apparently, craft breweries, they're having to shut down operations because there's a shortage of CO2. So apparently, that's what gives beer its bubbly texture.
Fizz.
Yeah. Right. According to this article, almost 2.5 grueling years of shutdowns, restrictions, staff shortages, and rising prices for ingredients. Some local breweries are now having to contend with yet another threat to their business model: climate change. No, I'm excuse me. I'm just joking. Limited supplies of carbon dioxide. Carbon dioxide is an essential component of the crisp beer experience. CO2 gives the beer the bubbly, foamy appearance and taste, and apparently they can't get it. So
I wonder if the soft drink companies are having the same problem.
Don't know. It's an interesting question. But warm and flat is not where beer is at. That's the nobody shows up at nobody shows up at the bar and says, "I'd like a warm flat beer, please." Maybe a flat tire, but not a warm flat beer. So interesting. Just interesting. I mean, we keep having these kind of rolling shortages of stuff that show up, and wouldn't think that CO2 is an issue. Just breathe heavier. So
get a cow. No, wait, that's methane.
It's methane. Exactly. All right. I told you all the story that when I was, my family traveled over to Italy earlier this summer. We went to see our son that we hadn't seen in a couple of years because of the COVID lockdowns. And so we all met up in Maiori, Italy. Great little town, beautiful, very scenic. It's expensive for them, cheap for us. Stuff seemed pretty inexpensive to me, but everybody was complaining about how high the costs were. But I understood two things leaving Italy: that why Italy has the best race car drivers in the world, because they drive 90 miles an hour on these winding mountain roads with about 1.5 inches between vehicles, and particularly buses. Literally you're driving down the roads and the taxi drivers are have the automatic mirrors that fold in, and they see the bus coming, they fold their mirrors in. It's like, it just squeak by. So, you're a little older after every taxi ride in Italy, but I do understand now why they have the best race car drivers. The second thing I learned in Italy is that a lot of people show up there with Mega-Yachts. We would, so this house that we rented a house up on the side of this mountain in Maori, and it overlooked, kind of this inlet of the ocean, and there were just yachts parked everywhere, right in the water. And it was interesting because these aren't your 30-foot yachts, right? These are your mega yachts and super yachts and those type of things, 100, 150, 200, feet long type things, helicopters on the back, that type of stuff. The reason I bring this up is that there was an article that Brent put up on my note list this morning called "Rich Guy Yachts Just Keep Getting Longer." And in case you needed a stronger indication that normal people are being taken for a ride in late-stage capitalism, historic inflation is being accompanied by a worldwide boom in the number of billionaires. All of those new members of the ultra-wealthy are buying super, mega, and giga yachts. I haven't heard that one before. To set them apart from the land-based poors. There are so many deeply incredible and infuriating pieces of information from the New Yorker story about the world of private yachts that you need to read this article. But it is an interesting article, but it talks about, the inflation of yachts by the super rich. And again, when we were in Italy, it wasn't just one or two yachts that were sitting in the water, and there's just all down the coastline, and every port you went into, there was 5 and 10 at every single port. And when we went over to Isle of Capri, there was just the entire island was just surrounded by these mega yachts, and again, just a massive amount of wealth that exists in the world. But we've talked about before that a lot of this wealth is concentrated in the hands of very few, but this is also why, we see all of these, this angst about, why and why capitalism is broken and these type of things. And I find it interesting because, there's my kids watch TikTok and stuff like that, and there's all these people that come on and they have these live debates, and you can debate with them. And it's just some guy, sitting on his phone, and he's willing to debate topics with you. And no, they're always wrong, right? They debate wrong facts. They don't have real, these are young people with no real economic history behind them. But they just kind of spew out the party lines, right? That socialism is better and capitalism sucks and all this stuff, and really have no idea. And as they sit there, and you have to kind of almost laugh at it, because at the point they're saying, "Oh, capitalism sucks," right? So what are they doing? They're sitting there wearing designer clothes, right, of some sort, whatever clothes they're wearing, using an iPhone, right, working on TikTok, hoping to get paid some money for it, and, helping promote other products. And so it's interesting because the very thesis of capitalism is broken is what they are using to make other people wealthy. And again, in order to participate in this economy, right, and to do these things, right, if you want to complain about socialism on social media, you've got to go buy an iPhone. Tim Cook appreciates that, and he has a super yacht. So there you go. I'm sure the CEO of TikTok, whoever he is somewhere in China that has all of your data now, would absolutely appreciate you using his platform and making him even wealthier in his own right, right? And so all these things that we do, the clothes that we buy, and in fact, if you go to the Isle of Capri, there's the mansions that belong to all the Italian designers, right up at the top of the mountain, overlooking the poor people. And they appreciate all the clothes that you buy from them. This is what I find really fascinating about YouTube and TikTok and all these things, right? And Instagram. Everybody wants to, follow and promote and be like these people that are on TikTok, yet they complain about capitalism, right? They go, "Oh, capitalism sucks. I'm not getting my fair share. Let me go follow Kim Kardashian, who's like 100 million, followers or whatever, and let me go buy all the products that she promotes to me." Right? So I'm making Kim Kardashian rich, or I'm making, Joe Blow rich, whoever it is that's promoting some product on social media. I'm making that guy rich, and I'm helping that guy participate in capitalism because that guy was smart enough to get up and create a channel that people wanted to watch. He's, using his creative talent, and now he's promoting product and he's getting paid for it, and all these people are following him. And so while these people are following, complaining about, the the capitalism is broken meme, they're actually promoting capitalism. Because what is capitalism? Capitalism is the ability for somebody to go out and start something, use their creative talent to create something that they can make money with. And that's what they're doing. And so, we should respect that. We should honor that, right? Some kid went out and created a channel, and he's making, there's one thing that's always kind of fascinated me. There's a guy, and again, I'm old and I'm outdated, so I'm sure there's somebody newer than this guy. But one thing that kind of shocked me when really YouTube really first started taking off, there was a guy named PewDiePie who, do you know what I'm talking about, Britt?
Oh, yeah.
Yeah, okay. So PewDiePie, all he does is he streams himself playing video games. And he had, like 5 million followers, right? Just some an insane, and it probably had more than that, honestly. There's probably in the double digits of followers because he was extremely well liked, and he was just a funny guy who played video games and streamed himself commenting while he was playing video games. He had all these followers, and the guy was making $5 million a year off of YouTube, right? But here's a guy, he found a niche, created an opportunity, and made money from it. Good for him. I wish I would have thought of it. And this is really, kind of the funny thing about all of it. It is that, we all want to sit around. I remember when back in 2008, we were on the radio back then and doing a political show, and we were talking about the Occupy Wall Street that was going on at the time. And this was really that first, this is, if you don't remember, I know it's been a long time, and there's a lot of people that weren't even alive then. But back in 2008, of course, people were getting kicked out of their homes. Banks were repoing homes they didn't even have mortgages on. It was just a very bad situation economically, right? It was the financial crisis of 2008. And in the midst of this, of course, the bankers, Wall Street got wealthier, the bankers got wealthier, and the poor got poorer. And this launched the first, and this is really where all this kind of ire started. And we all started, we go, let's all go riot every week about something that we're upset about. But it all started back with Occupy Wall Street. And all these young people went to New York and they occupied Wall Street. It was the 99 versus the 1%. And they're all complaining about the 1% while they're tweeting on their phones and, working on their laptops and leaving trash everywhere. But, the very thing they were rebelling against were all the very products that they were all buying and using. Look, if you want to really get to the rich people, stop buying their stuff. Stop following them on Twitter and Instagram and Facebook. Get on with your own life. Go create your own capitalism. That's what capitalism is. You create your own opportunities. Nobody's going to give it to you. But you can certainly hurt those that you don't like. Just stop following them. It's pretty easy. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Mexico is now upset. There's been like 1.5 million people, a lot of them from California, have now moved to Mexico City because of cheaper rent. Now Mexico City is getting very upset because they don't like the impact on their culture.
The Real Investment Show podcast.
Mexico City is getting very upset with the immigration and they want to stop it.
Don't American my Mexico.
Exactly.
At realinvestmentadvice.com.
It's like, stop it.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Futures are kind of a little mixed this morning. Dow's up about 9-10 points. NASDAQ's down about 70 points. So again, a little bit of a drag left over yesterday from NVIDIA's earnings, which was interesting because NVIDIA said, well, their gaming segment, where people buy cards to video cards to game with, etc., which is what NVIDIA specializes in high-end graphics, video cards, those type of things, and so a lot of gaming applications. And it's interesting because what they said was they expected a revenue slowdown after this kind of blockbuster couple of years that they had. Now, stock took a hit yesterday, and not surprising, but the announcement really wasn't all that surprising either. We have to go back and think about what happened over the last couple of years, right? And we've seen this in other companies, not just NVIDIA. We saw it with Peloton and others, right? You send money to households. People have a bunch of cash sitting around. They can't go out and do anything because they're all locked down because of this, this COVID thing. And so what do they do with the cash? They spend it, right? So we had this boom of economic activity. People were all going out buying Peloton. I can't tell you how many people I knew that went out and bought a new coat rack for their house called a Peloton. It was a very expensive coat rack, but they bought the Peloton bike and, had it, the guy comes out, they install the bike, they use it once, and then they start hanging clothes on it. But of course, after the pandemic is over and people are going back to living their normal lives and getting on with things and realizing, it is what it is, then all of a sudden those sales just plummeted. Well, the same thing happened with NVIDIA, right? So all these people are locked up, especially the kind of the young millennials, zillennial, whatever you call them, crowd, Gen Zers. Well, their first inclination is to game, right? So they're all hanging around. They kind of run through the whole social media thing, and they're online working, a couple hours a day. Well, the rest of the time they're sitting around and they're video gaming. And so there was a big boom and big demand for video game cards, and that was a big push in the earnings of NVIDIA. And of course, NVIDIA's had a couple of different challenges over the last few years. They also provide the graphics cards that are used for Bitcoin mining. And so when Bitcoin mining was really taken off, they had a big surge in earnings because of the Bitcoin craze. Well, after that first kind of big, downturn in cryptocurrencies, that demand for mining went away and video games took over. Well, now things are just kind of, and so while NVIDIA's, predicting a slowdown in earnings, it's just a normalization of what the earnings should be based on kind of a normal economic environment, not one that's been juiced up by a bunch of, checks to households. And so, so you have to kind of look through these earnings and kind of look at where their earnings trend is supposed to be relative to where it was because of these one-off effects that have occurred. And so, the world is just slowing down now. And if there's a company that I want to own, when I get to 2030, 2040, it's going to be NVIDIA. It's going to be one of them. And there's companies like that you can identify saying, look, where the world is headed to is not one where their product is going to have less demand. Yes, they're having less demand right now because things are just normalizing from these super elevated peaks of demand that were caused by artificial interventions. Also created that inflation spike that we're talking about. And so things are just returning to normal. And the question is that normalization process how long does it last? But, just something to, kind of think about. And this is where we kind of come back to this, look at the markets. And as we were talking about earlier on the show, the markets are in this corrective process, right? And you can break this market down into a bullish argument, and there's lots of reasons that you can come up with to be bullish, right? Technically, there's a lot of signs to be bullish on the markets. And, there's, other kind of factors that you can build in. Investor sentiment is so bearish on many cases. Now that's turning fairly quickly. Bearish sentiment is now becoming more bullish, but it's not uber bullish yet. So there's still that negative sentiment. We've got to drag more of those bears back into the market to make them bulls, right? And so there's that, and that helps push asset prices higher. Short covering's been a big factor of this rally so far. Higher income consumers, those in the top 1% with Mega-Yachts, they're doing just fine, right? They don't even recognize there's inflation. It's just, diesel prices have gone up. One of the big complaints of yacht owners is the cost of diesel fuel. I'm sorry, their diesel fuel's eating up their budgets. But, these are those, there's a lot of factors that we can say, support higher asset prices. And this is one of the things that is important to remember, is that you can have an opinion that says, look, I think the market's going down for all these reasons, or I think the market's going up for all these reasons, and you could be wrong. And this is one of those really challenging times in the markets where I can make a really good bull case for being long equities. I can also make a really good bear case for being short equities right here. And depending on your personal bias, you're like, well, tell me the bearish story or tell me the bullish story, right? So it depends on your personal bias and what you're kind of hoping to get out of the markets. And the reality is that I have no idea which one is going to play out, and neither does anybody else. This is the fact. All these people telling you on television or in the financial media is like, oh, the bull market's back. They have no idea. Though, likewise, everybody telling you that the market's going to go lower, have no idea, right? We're all guessing. It's all a guess. And this is why we have to just navigate the markets for what it gives us, right? We've had a bit of a rally here. We added some exposure to portfolios a week or so ago. When the market rallied, it got overbought. We took that exposure back off again. We just have to trade this for right now because that's the risk. The market could go up from here, right? So if we could get an ideal setup would be the market pull back to the 50, 20-day moving average, which are sitting right on top of each other right now, consolidate there a little bit, work off this overbought condition, and then begin to move higher. That would be a great opportunity to add some money to portfolios, and you're going to get a nice little leg out of the market higher. Likewise, the market starts to correct, cuts through those two moving averages. We're going to retest lows pretty quick. And you're going to be glad that you're underweight equities at that point. But again, until you get there, until you get to that intersection of the road, you have no idea which way to go. And this is the problem. And again, there's a lot of articles right now. There's a tremendous number of articles being written. We put a chart in our daily commentary on Monday showing the number of articles being written on new bull markets. It's a new bull market. Huge surge in those. But at the same time, there's a lot of articles being written about why this is a bear market rally. And so the question becomes, well, Lance, tell me what to do. What do I do? I don't know what to do. If I knew what to do, I would tell you what to do. This is why we have to just navigate this every day for what it is. This is why every day on the show, when we come on the show, we talk about, hey, here's what the market did yesterday in our daily commentary. If you're not subscribed to our daily commentary, get subscribed. Go to the website, click on the daily commentary link right there on the front page, and on the right-hand side, once you get to the commentary, is a subscribe button. But every day we put a trading market update in that says this is what the market did yesterday, this is what we expect it to do today. Here's what to watch for. Because we don't know. We just have to navigate this for what it is. It's kind of like driving a car. And in a lot of ways, it's like driving a car. How often have you gotten in your car and you're driving somewhere and you kind of just mentally wake up and you're 5 miles down the road because you were off, kind of in Neverland thinking about whatever you were thinking about. And all of a sudden you're 5 miles down the road and you're like, wow, I don't even remember driving that last 5 miles, but you did. And that whole time, though, your body's making these minute adjustments to the car, right? You're turning a little bit left, a little bit right, keeping your car in the center lane, tapping brakes when you need to, accelerating when you need to. But your body's automatically making all of these changes while you're driving a car, even though your brain's off and doing something else. Or you're driving with your knee, eating a hamburger and TikToking. One of the whatever you're doing, right? You're doing. But your body's making all these minute adjustments to drive the car. Well, it's the same thing with the markets. We're traveling down a highway here, and we have to make these minute adjustments to the portfolio to navigate getting there. And sure, we can, and we've talked about before about, the risk of one-sided bets and, betting a whole lot of money on commodities. For example, we wrote an article back in May talking about why it was time to take money out of energy stocks. And the reason is that energy had gotten extremely overbought and you're going to have a correction. And at that time, everybody was like, I just want to be long energy stocks. Energy stocks, they're never coming down again. Well, they've come down and now they're actually in a much better position. But again, you have to just think about markets for what they are. Don't get tied up into this bull argument, bear argument mess. Markets are markets. They can be bullish one day and bearish the next. We just have to navigate them for what they are. Be right back after the break. We'll wrap up the show.
investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
The other day we were talking about the new Farmer's Almanac and the old Farmer's Almanac. There's two Farmer's Almanac.
Dueling almanacs.
Dueling almanacs. So
Yes.
you gave me a link this morning. Bitterly cold air. Farmer's Almanac predicts another chilly Texas winter. But is this the new Farmer's Almanac?
I don't know.
Because that must be the old Farmer's Almanac, because I read a headline the other day from the new Farmer's Almanac that said we're going to have just a moderate winter here. However, North United States, right? Montana and Nebraska, they're going to have glacial winter. Ice age type winter up there. So
mastodons.
It's something, because so apparently you must be coming from the old Farmer's Almanac, which says that we're going to have a winter weather forecast earlier than ever. As much of the country experiences extreme weather and rising cost of heating oil, the long-running publication predicted 22-23 winter will be filled with plenty of shaking, shivering, and shoveling. And
How
skiing.
alliterative.
Yeah. The coldest winters are expected. Well, this is okay. Well, no, this is what I said. The coldest winters are expected in north central states, the Northeast, and the Great Lakes area. So
There you go.
but as long as we don't have another freeze like we had back in Texas, right? I'm good with that one.
It'll take a cold one just to get stuff cooled off from this month. I mean, it's glowing red out there still.
Pretty much. Yeah, we were pushing up 100 degrees yesterday, and today, the rest of this week, we're supposed to be pushing well into the 100-degree mark. So, yeah, I'm not looking for my run on Friday. It was hot last weekend.
Oh, yeah.
It was bad hot.
Yeah.
So,
What time do you start that?
usually I get the newsletter out on Fridays. You know, we get our meetings and stuff done, right? So I'm normally out by 9:30, right? And so it's warm, but it's not hot yet.
Yeah.
But on Saturdays, it's by the time I get the newsletter out, it's later in the afternoon, and it's hot.
Oh,
so
yeah,
it's hot. So anyway. A couple of things to wrap up the show here this morning. Obviously, we have earnings still coming out. We've gotten through the bulk of earnings season now. Most of the S&P 500 have pretty much announced earnings. And we've got, kind of just there's still a lot of companies still coming out to report earnings, right? And that's going to continue through the rest of this month for the most part. But, this is, we've kind of gotten through the bulk of it. So again, that's going to start to slow down. And that's had kind of a mixed effect on markets, so far this quarter. I mean, we've had some days where, good earnings from companies like Apple and Microsoft, et cetera, help support markets. We've had other days where earnings have not supported markets. And what's interesting is that this has been a earnings period of where stocks are rallying on earnings not being as bad as expected. Now, there's nothing wrong with that, but the question you have to ask yourself, if you're starting to buy into this idea that the bull market is back and the bear market bottom is in, then you've got to start building a case for how stocks begin to have better than expected earnings. Because you can't keep rallying markets on not as bad as expected, right? Netflix came in, reported earnings, and only lost 1 million subscribers. It was expected they'd lose 2 million. So that wasn't as bad as expected, so the stock rallied, right? Well, if they lose another 1 million subscribers in the next quarter, well, is that going to be good for earnings? So at some point, we've got to migrate. If this is going to be the bottom of the bull market, right, then we've got to get to the point to where markets are beginning to rally on better than expected news, not as bad as expected. That's kind of an unsustainable trend for markets near term. It's okay for a quarter, but you can't keep stretching out not as bad as expected for multiple quarters, because eventually at some point you've got to start rallying stocks based on, well, I shouldn't say rallying stocks, but pricing stocks based on earnings growth, and expected earnings growth. So, not as bad as expected only gives you so much. And again, this has been kind of an interesting quarter because a lot of this rally from the lows that we've seen over the last several weeks has been a function of not as bad as expected earnings. Now, if this bull market is going to continue, it's got to improve. And that's one of the things that, we're watching for, right? So the question is the economy slowing down more, or have we pretty much wrung out most of the economic slowdown? And that's a hard argument, right? On one side, we've had, pretty good slowing in economic data. Economic data is getting pretty bearish on a lot of different fronts. And expectations, and this is always, again, we go back to, kind of expectations for earnings. There's also expectations for economic data. A lot of the expectations for economic data has gotten pretty negative. So now there's that potential for economic data to start to surprise to the upside, not as bad as expected. And so the question is have we gotten to that trough of economic data to where we're starting to see better and improving economic data? Well, some of the economic data that is out is still getting weaker. ISM, manufacturing, production, those type of things are all still showing declines in new orders and prices paid. And as we see the economy return back to kind of a normal growth rate after this kind of surge in economic data because of all the stimulus, suggests that there's still some more downside to go in that economic data. But we're not back to levels of normality yet in that data to suggest that we've seen the bottom. But the question becomes ultimately really down to the Federal Reserve, right? The more they hike rates, the more aggressively they hike rates, then of course that's going to slow economic data even more, because that's what it does. I'm hiking rates to reduce consumption and demand in the economy. That slows the economy. That brings pricing down, right? So that's how you get rid of inflation. It's not subtle, it's not pretty, but you can't attack inflation all by itself, right? There's not a tool where I can just go target prices but leave the rest of the economy alone. That's just not the way it works. And as we've talked about before, about 40% of the CPI calculation is housing. And we're starting to see a lot of houses sitting on markets longer. A lot of the bidding wars have subsided. We're seeing home prices being dropped at a fairly rapid pace. starting to see listings decline. So there's a lot of evidence that the housing market is beginning to slow down. And the question is the housing market, just starting to slow down, or is it almost over slowing down? Is how much farther does it have to go to get to, whatever it's going to be, right? But housing prices got very extended from long-term means, and that suggests that there's still a good bit more to go in the housing market before this is over. And again, that'll be a consequence of what the Fed does. So again, we kind of go back to this bullish, bearish argument we was talking about in the last segment, is that, we can make a case for markets to be bullish. And I think on a short-term basis, there is a bullish bias to stocks, at least for right now. And what's interesting is there's a lot of analysis that says, well, since 1990, every time stocks have done this, then, they 1 year later, stock prices were higher. And sure, that could be the case. But this environment is a little bit different, and we're in an environment that we haven't seen since the 1970s, where the Fed was aggressively hiking rates to combat inflation. And that just wasn't one point, by the way. In 1960s and 70s, there were multiple bouts of inflation, multiple periods where the Fed was hiking interest rates. And in every case, they created both a bear market and a recession. There were multiple recessions between 1960 and 1985. And multiple bear markets. Most people think about when they look at that period, they only remember the 1973-74 bear market because that was the big one, right? There were 3 other bear markets before that in the 1960s. And those previous bear markets led to rallies that actually got markets back to all-time highs, right? And everybody's like, woo, glad that bear market's over. And then, bam, another bear market. And then got back to all-time highs. Woo, glad that one's over. Boom, next bear market. All-time highs, boom, 1973-74 wiped them out. But the reason you were getting those rallies and bear markets was because the Fed was either hiking aggressively or reducing rates because of inflation. But we only remember the big ones, right? Right there at the tail end. We don't remember all the other stuff that happened. So again, if we kind of just go back and look at, and I'm writing an article on this, by the way, so I'll have it out in a few days. But, when you go back and look at that period, it tells you a lot about kind of what you might want to be thinking about as a possibility of where this market looks like over the next couple of years. And whether or not, and of course, all this really depends on how fast that the Federal Reserve can get inflation under control. And what happens if it comes back? I mean, what happens if this Inflation Reduction Act actually causes more inflation? Something to think about. All right, get by the website, realinvestmentadvice.com. Our newsletter is out. You can subscribe to that. We send that out every weekend. That's the only email you're going to get for that list. So if you subscribe to the daily email, you'll get a daily email from us, which covers all of our daily market commentary, interesting tidbits, and more about the markets and what to do with your money. That comes out every morning at 7:30 a.m. before the market starts. And of course, you can get access to all of our research platform and more at simplevisor.com. Go to the website, realinvestmentadvice.com. Questions, comments, answers, whatever we can do, glad to help you. realinvestmentadvice.com. Have a great day. See you back here tomorrow.
All the things I could do if I had a little money. It's a rich man's world. It's a rich man's world.